Let's talk money.
Hello and welcome to a brand new edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. Now, on this program over the last year or so, you would have heard a lot of experts, a lot of personal finance pundits come and tell you that asset allocation is crucial. Now, let's face it, when the equity market is roaring, we rarely give enough importance to that advice. But the last 6 odd months have taught us the importance of asset allocation. When you see equity struggling, you see your NAV is down in the equity funds, but you realize that gold has been shining, or even some debt funds could have been outperforming. So asset allocation is important. The question is, how do we do it in our portfolios? Well, joining me to answer this are Mohit, who's of course founder and CEO at Moneyfront. And today I have also with me Ihad Dalwai, senior fund manager at ICICI Prudential AMC. And Ihad manages ICICI Pru's multi-asset allocation fund, among others. Gentlemen, thank you very much for joining us on the show. So I'll open with you, and I'm sure today people will listen to both of you more carefully, because otherwise this asset allocation gyan, as it's called, sometimes, in a roaring bull market, people don't want to pay too much attention. So Mohit, opening thoughts with you.
Thank you so much, Surabhi. Always a pleasure to be on your show. Look, I think for ages, portfolio managers, asset managers, and we wealth managers have been crying hoarse that perhaps the best thing to do for a client is to have good balance between equity, fixed income, commodities, and maybe a few other assets depending on the profile, right? It's oft ignored, as you rightly said, because of the market movements. Once you get carried off in a market frenzy, then you typically tend to ignore the basic fundamental principles, the 101 of finance. But if you watch the data for last 6 months, 1 year carefully, and maybe even on a longer time frame, you'll realize that if an investor had a proper mix, a proper dilution between equities, debt funds, commodity funds, which is gold and silver, the returns would have been far, far superior. The moot point here is risk-adjusted return. So for a lesser unit of risk, or for a much balanced unit of risk, you get perhaps higher returns, or you get almost equivalent returns from just holding a pure play equity portfolio. So were you in 100% equity versus you were in a 60-40, 65-35, or a debt equity portfolio, or a 50-30-20 equity, debt, commodities kind of a portfolio, your returns would have been much superior in last 6 months to last 1 year. And risk adjusted, you would have slept very, very peacefully.
Oh, absolutely. And I think we'll just pull up some of the data points there. If we can drop the comparison of asset classes per se, the Nifty 50 has obviously corrected. The Nifty 100 has corrected even more. But the reason we've picked up some of those other funds is to give you a flavor or an indication of how other asset classes have done. That's the CRISIL Hybrid Fund, which has a mix of 35-65 equity and debt. And as we can see, on a 6-month basis, it's fallen less than equities. On a 1-year basis, also it's an outperformer. And if you look at gold and silver, Edelweiss is just an example. We picked up one AMC as an example, but because of the way precious metals have rallied, look at the returns for that fund: 31% versus 1% on the Nifty. So they say the market is the best teacher, and the market has definitely taught us that lesson in the last 1 year. Ihad, come in on this. But, if I could argue from the investor side, sometimes it's also confusing, because all you folk also say that when we are young, when we are earning, especially young investors, they should load up on equity in a big way. And maybe that's another reason why people tend to ignore. When you're young, you don't want to think fixed income or debt or too much diversification. So how would you approach it?
Yeah. So see, basically, it's important to understand how these asset classes have performed over a long-term period. And if you look at last 10 years data as well, so debt has come out as a winner 2 out of 10 times. Equity has come out as a winner 3 out of 4 times, 4 times out of 10 times. And similarly, gold as an asset class has come out as a winner. So it is important for us to understand that each of these asset classes perform differently in the different phases of the market. So for us, it's important to understand what is the outlook for each of these asset classes and how we should allocate them in a balanced portfolio. So obviously, over a long-term period, equity tends to do well versus most of the other asset classes. But when equities tend to do well, it is to some extent important to do some profit booking and shift to the other asset classes, because there have been historical precedents that these asset classes also do well versus equity.
And now I guess, Mohit, the numbers are telling us that story,
Absolutely.
right? Equity has been struggling, but gold completely shot up.
Yeah.
Okay, fine. Point taken. We need to have diversification and separate asset classes in our portfolio. Now, where do we begin? I mean, there is the simple get a hybrid fund approach. There's also maybe I'll do my own equity funds. I'll add my own debt funds. What would you advocate?
Surabhi, I think it totally depends on the profile of the investor. If you are an investor who's kind of involved in your portfolio, who understands the nuances of the markets a little bit, who understands the different kind of asset classes, what does each asset class entail in terms of risk and rewards, right? Then perhaps the better approach is to determine your asset allocation yourself or by sitting alongside a financial advisor, right? So there you can decide whether a 50% equity composition or a 65% equity composition is good for you, and simultaneously also decide what kind of debt and commodities composition you want. And depending on what your objective, financial goals, risk profile, other things are, you kind of allocate assets accordingly into pure play categories, which means a pure play equity allocation, a pure play fixed income allocation, and a pure commodities allocation, which could be a debt, which could be a combination of gold and silver or whatever, right? So that's, to my mind, the best and the right approach, which also requires one to be being involved in the portfolio. If you're a little hands-off investor, you don't want to get into the nitty-gritties of asset allocation yourself, don't want to study so much, don't want to determine the right choice, right mix, and the reshuffling between these, which is the most critical part, which is often ignored, and often the retail investors can't do that, is the reshuffling between these three asset classes. Then perhaps you say, okay, I am just putting my hands up and I'm giving it to better money managers and fund managers and professional advisors, and then taking cushion in hybrid funds, in balanced advantage funds, in multi-asset funds, which will give you the best of all the worlds. And perhaps the good part is managed by professional fund managers and systematically managed with discipline and with proper research, good allocation mixes, and which keeps changing timely, right? So you get best of everything, and you can just, again, as I said, just be peaceful.
Absolutely. Leave it to the experts, so to speak.
Absolutely.
Ihad, what would you say? Because as an asset manager, you offer both options. Someone can come and individually pick debt funds that iPru offers along with equity funds, or maybe even, you know, a gold fund. Or you can go for some of these composite products, for instance, balanced advantage funds or a multi-asset fund. Personally, what approach do you think is right for a retail investor?
So generally, if an investor is a bit confused in which asset class one has to invest in, I think the easy way out is to just invest lump sum in these hybrid schemes, because ultimately, like Mohit suggested, was that it is for us to determine what allocation we have to do for each of these asset classes. And it's important to understand that these asset classes will perform differently in different phases of the market, like I mentioned earlier. So I would still suggest that hybrid schemes is a better way of doing it, because an individual will find it a bit difficult to determine which asset class is expected to do well in the near term. So I think it's best left to the professionals to determine that. One more point I wanted to highlight was that it's more cost efficient for an individual to do it through the hybrid schemes versus to do it at an individual level, because the reallocation or the calibration which we would be doing across these asset classes, I think it's more cost efficient in the hybrid scheme versus doing it at an individual level.
Oh, fair enough, yeah, because every time you are selling and moving some money to a different asset class, you'll have to deal with the capital gains tax, whether you're shifting from debt to equity or equity to debt. Got that point? Point well taken. So hybrids are the way to go. But now hybrids as a universe is a fairly complex universe, Mohit. I mean, it's not an easy, world out there. Absolutely. I might argue that it's even more difficult than picking a, mid cap or a small cap, where the definitions are absolutely watertight. So within hybrids, just revise the universe for us, what our options are, and then what should be the first parameter? When I'm thinking of, getting into a hybrid fund, what's the first filter that I should apply?
It's a massive category. It's a quagmire of funds out there. You have hybrid, you have balanced advantage, you have dynamic asset allocation, and you have multi-asset, right? I hope I have not missed anything, but yeah, to my mind, I think those are four broad-based categories. The first things which an investor needs to know is what allocation does he want in equity and debt. What is the kind of allocation he's looking for? What are his long-term objectives? What are his long-term financial goals? And how much risk is he willing to take? So he has to be very comfortable as to, let's say, if I'm investing for 1 or 2 years or I'm investing for 5, 7 years. That's number one. whether I'm okay to go with a slightly aggressive tilt within the asset allocation model itself, or I'm wanting to keep it low profile, conservative, very less equity oriented kind of a thing, right? So you need to answer these 2 or 3 questions, basis which you will determine what kind of allocation do you want. So I could be an investor. I say no, at every point in time, I need to have a fixed allocation between equity and debt, and that allocation will be more in favor of debt. Okay. So then I go for a conservative hybrid fund, where the allocation is broadly streamlined, that equity won't cross 25% and the remaining portion will be debt.
That's a conservative hybrid
That's a conservative hybrid fund. Then you have a moderate hybrid fund and you have an aggressive hybrid fund. But the allocations between equity and debt are fairly stable. It doesn't change too highly or rapidly. But I'm an investor who say I want to also make use of market movements. I want to shift between equity and debt and let the fund manager take that liberty to move the allocations. Then I'll perhaps go for a balanced advantage.
Which is dynamic asset allocation.
Which is dynamic asset allocation, where the fund manager, now each fund manager will have their own criteria. I think for Pru ICICI, perhaps it could be a price to earnings and price to book value kind of a model, which they follow in Pru Balanced Advantage Fund. And where they will dynamically determine as to what portion of money has to be kept in equity and what portion in debt. And they will keep shifting between the allocations. So if the markets go up frantically, they will reduce equity and increase debt. If the markets are falling, which is the current scenario, they might perhaps be increasing equity allocations in their portfolio and reducing debt, right, to make use of the market movement. So that's been a time-tested, proven methodology. There could be a third approach where an investor says, I want the best of all worlds, not just equity and debt. I want a flavor of commodities. Maybe I want a little international. I want REITs and InvITs in my portfolio. Then perhaps the best way, which is to go as a multi-asset fund, where you will have equity, you will have debt, you will have commodities to the tune of around minimum 10%, which can go up to 20-25%. Some portion of REITs, InvITs. Sometimes some funds do take international investing also as an option. But it gives you a comprehensive world of investing just packed in one single fund. So again,
so lots of options. You need to know what you want.
Absolutely.
What is it that you're after, and more importantly, how much risk can you stomach? Ihad, on this very point, and we'll go through these individual categories specifically. But you know, overall, let's get the low risk investor out of the way first. Anyone who's low risk, who's not getting into a hybrid fund for high returns. Maybe you know, he or she is retired, or maybe just generally they don't want too much risk. Then what is the category of hybrids? What type of hybrid funds would be suitable for them?
So like Mohit also mentioned, for me as well, I think the risk grading is such that BAF or MAF, and the first is obviously ESF, like you said, it is a lower end of, in terms of risk profiling, it is on the lower side. But if someone wants to take some slightly more risk and is looking at hybrid as a strategy, BAF, MAF, aggressive hybrid, and also there is an asset allocation fund through a fund of fund route also is something one can consider. But my preferred choices have always been a dynamically managed asset allocation, because I feel that, like I mentioned at the start, is that each of these asset classes perform differently, are volatile. So if you have a dynamic model, back-tested model, which has succeeded over a period of time, you can gain out of the volatility and try to generate returns or alpha through the volatility. So my preference would be a dynamically managed fund, maybe a balanced advantage fund or a multi-asset fund.
Okay, so multi-asset or balanced advantage. Got that. That is Ihad's pick. We'll take a break, but we dive a little deeper. Now we've understood that BAFs, as they are called, balanced advantage funds, or MAFs, as they're called, multi-asset funds, they're good funds and they can help you across multiple asset classes. But how do you pick one fund in these categories? Back with that in just a bit.
Let's talk money.
Welcome back. You're with us on Let's Talk Money, and this week we are talking about hybrid funds and why you probably definitely need to have them in your portfolio. Asset allocation is key. Mohit is with me in the studios, and Ihad of ICICI Pru is with us, joining in remotely today. So, gentlemen, like we've now sort of established the broad categories and the big popular ones as well, before I talk about balanced advantage or the multi-asset allocation funds, very quickly, Mohit, is there any reason for a low-risk investor, maybe a retiree, maybe someone who doesn't want to take aggressive bets in the market, is there any reason for such an investor to consider conservative hybrid funds? Wouldn't they just be better off in a fixed deposit in that case?
Look, Surbi, I firmly believe that if you're a conservative, very conservative investor, you should try and seek some portion of your allocation into equity savings category or conservative hybrid category.
Okay.
Now, both these categories suffice different needs. So if you're into equity savings category, the pure equity composition can vary between 15 to 25 odd %.
Okay.
But the remaining composition is arbitrage to take the overall composition of equity above 65, which is the taxation limit. And the remaining composition is...
this is really important. I'm going over this again. So the total equity exposure becomes 65% in the equity savings category.
Absolutely.
So you actually get the benefit of equity taxation.
You get equity taxation, which makes it highly effective as a category.
But it's a safe category of funds.
It's a broadly safer category because you are into predominantly arbitrage and debt portion. The pure equity portion is hardly 10 to 15%. Again, it varies between fund house to fund house, but yes, it's a predominantly a very safe category and gives you equity advantage as in form of taxation. The conservative hybrid category will have equity composition between 10 to 25 odd %, and the remaining portion is debt.
Fully debt.
Yeah, this is more for an investor who's still looking at a 3 to 5 year kind of a view and who wants some element of capital protection built in by virtue of a large debt allocation, but a little kicker of equity. Just a little upside out there.
All right, got it. Makes perfect sense. Now, equity savings, that's a good one to look at because it's tax efficient and it's relatively safe returns, perhaps stable returns. Got it. Now, Ihad, I want to move to your favorite category, which is dynamic asset allocation, where the fund manager has the flexibility, the asset manager, to decide how much equity, how much debt, how much commodities, etc. Right? So let's start with first, BAFs, balanced advantage funds. Now, all BAFs are not similar, right? Different mutual fund houses have the different criteria in terms of what is the algorithm, how much should be equity, when should it be rebalanced. So in general, what are the industry practices and how should I, as an investor, pick the right BAF?
Correct. So see, broadly, the method of managing the net equity level can be classified into two halves. One is one can adopt a counter-cyclical approach. That is, as and when market is correcting, your net equity rises. There may be few products which have adopted a momentum approach where, like, as market falls, you try to reduce your net equity level. So I think the thought process which I like is a counter-cyclical approach because it helps you average out better as market keeps correcting, you keep increasing your net equity, and as market does well, you do some profit booking, you reduce your net equity level, and you shift to the other asset classes. So these are like broadly two basic methods of maneuvering your net equity level. Having said that, there can be the frequency of change can also vary. So there can be a daily rebalancing which is done and which can be a gradual increase or decrease. At times you can see a sharp reduction or sharp increase in your net equity level. Few products may follow that process. I think the preferred choice is a gradual method of increasing or decreasing net equity. So broadly, these are the two differences, but I feel most of them would be under the equity taxation, at least in the balance advantage fund, meaning that the gross would be at 65%. But the net can vary. So for example, it can go as low as 30% net equity, can go as high as 80% or even higher. So the variation can be quite high in terms of the net equity level.
Okay, so it could be very different. Mohit, let me ask you. I mean, so like I said, not all BAFs are equal. Yeah. So how do you pick and choose?
Look, I think broadly the style of picking, I think, is highlighted pretty well on that front. My choice still, Surbhi, would be a multi-asset fund for investors, basically, because they get the best of all the worlds, right? So I firmly believe in that approach that one size doesn't fit all, right? So you need to have some commodities in the portfolio to give it a good texture. We have seen at the start of our conversation today that how a little element of gold and silver could have really propped up your portfolio in terms of last 1 year, 6 month kind of returns. So a multi-asset gives you commodities, it gives you some element of REIT InvITs, it gives you some element of debt. And then it always will try and keep your equity between 50 to 65%. Again, you will have to select a fund depending on your choice as to what kind of equity do you want in your overall portfolio. If you want a slightly aggressive tilt, you will have to go with a 65 and above kind of equity. If you want a little moderate tilt, then you go with a lesser equity composition and higher debt and commodities.
But this is not static, right? I mean, if you pick a multi-asset fund, which right now might be having a higher equity exposure, But that could change when the fund manager feels the cycle has turned.
Absolutely, and that's the beauty of it all, right? The captain and the selector of the team will have to decide whether they want Varun Chakravarti or they want a pacer, right? Depending on the pitch and the market mood. So if they want to go 10% in commodities, which is the minimum stipulated regulatory level, they can. Or they can go 30-40% in commodities and reduce equity. It all depends on how dynamically the fund manager is doing the markets.
So as a mutual fund investor, what should I look for? I should back the fund manager who I feel is more adept, or because I can't stick to that. I want a MAF with at least 50% equity exposure, because that is not cast in stone, right?
I think the philosophy of the fund house or the fund manager will have to be understood before investing. Broadly, they will tell you that this is how we look at it and this is the range within which we can move. We will make aggressive movements, or sometimes the fund houses will tell you that, okay, no, we will always at all points in time keep 50% and above equity, right? So depending on that philosophy, you'll have to go, and you'll also have to see past record of asset allocation as to how they dynamically have they moved between the categories. Have they really shuffled across, or they've just kept a very static composition going?
That's a lot of hard work. So why don't you do it for us? We're almost out of time. So let's end this by asking you the most important question for all, which is the best hybrid funds to consider, including in the portfolio.
Look, if I have to choose a balanced advantage fund, I will go with Ihad's choice, which is a counter-cyclical choice, which is a true balanced advantage. If I have to go a slightly more technical choice out there, I'll go with an Edelweiss balanced advantage. On the multi-asset side, I'll go with a UTI multi-asset fund. If I want a very conservative multi-asset, I go with a DSP multi-asset. Or if I want a very broad platter of things involved, I go with a Nippon multi-asset fund.
Just quick reasoning on your multi-asset choices. Why that order?
No, it's not. It's in no particular order. It's just as to how I recall the names, basically. So I think UTI has a good composition of commodities. The performance has really stacked up, and they have shuffled the allocation fairly neatly. Same goes with Nippon. They have some element of REITs and InvITs also in their portfolio. The broad mix is pretty nice, right? DSP, because they are a little conservative in their overall approach on the multi-asset side. Their equity is not very high. So if you want a little conservative tilt on your multi-asset side, then you go with DSP.
Okay, all right. That's a quick crash course. We have lots of questions, but unfortunately, we're out of time. I mean, these are very technical aspects of, hybrid funds that we need to consider. But it's a start, at least. I think something for investors to think about. Thank you very much, Ihad, for joining us. And thank you, Mohit, for dropping in and explaining some of these very interesting funds to us as well. Well, with that, we're out of time on this edition of Let's Talk Money. Thank you very much for joining in. Keep sending us your queries and keep telling us what more do you want to know about. We'll take up that issue as a theme on the show in the coming weeks. Thank you for watching.
Let's Talk Money